On Wednesday, the Federal Reserve makes a decision whether to hike interest rates or not. And right now, the market is pricing in a 31% chance of an interest rate hike, a 25 basis point rate hike from the Federal Reserve as soon as Wednesday. Now let's simplify this the way we always do it here. A central bank, especially the Federal Reserve, does not hike interest rates for fun. They need two things. They look at two things, which is part of their mandate, okay? What they are obliged by law to follow and to actually protect. That is inflation and the labor market. Now, this is part of their mandate, what they actually need to follow by law. And in these two buckets, they need two things, typically need both of these two things to actually hike interest rates. Well, they need inflation that is expected to stay high or actually going higher pretty rapidly. And they need a labor market that is stable or doing okay. They need these two things to hike interest rates comfortably. So by understanding this framework, by understanding what the Federal Reserve is actually focusing on, well, at this point, we can start to analyze what the Federal Reserve is most likely going to do this Wednesday. So let's start with inflation, because where does this whole probability of a rate hike actually comes from? Well, it comes from the fact that oil prices have been on the rise over the past couple of weeks because the Strait of Hormuz has been closed over the past couple of weeks. Now, over the weekend, we've actually seen a de-escalation, slight de-escalation in the context, so prices are actually coming down a little bit. But for quite a while, the expectations have been, pretty logically that oil is up, which means inflation next is going to be up, which means the Federal Reserve needs to hike interest rates as soon as possible. Okay, the logic is sound, but the Federal Reserve is not that proactive. Oil is volatile, and for that exact reason, the Federal Reserve does not set policy off of headline inflation because it's volatile. And so they look at core inflation. Now, this is obviously nothing new. If you follow us, core inflation, it's what the Federal Reserve mostly focuses on, because if you set interest rates off the price of gasoline, well, you end up whipsawing yourself on spikes and falls in energy prices that are volatile. So we understand core inflation. Okay, well, what is core inflation actually doing? Well, the latest core inflation has been, not so surprisingly, because if you follow us, we've been calling this soft CPI print in advance. But essentially, core CPI has come down from 2.9% down to 2.6% and well below expectations. Why? Because oil prices in that period actually came down. So arguably, the market is justified to think, well, oil prices in this period are going up. So in August, the CPI is going to be up again. Yes, but we have to talk about this FOMC right now, today. Then, after this FOMC, we're going to be talking about the September FOMC. But for now, for this week, the one that's going to matter is this FOMC, because that's where the pricing is a bit misaligned. Now, it doesn't take an economist or a genius or a central banker to understand that this core CPI does not make the case for an interest rate hike at all. Okay? Simple as that. Inflation at this moment of time, with the data we have right now, does not scream for a rate hike at this meeting. Okay, so we understand the inflation side of the mandate is not really calling for an interest rate hike yet. Maybe it will, but at least not yet. So now what we do? Well, let's look at the labor market, because the labor market it's also fairly interesting right now. Because under the surface, it's showing some slight weakness. Now, nothing too concerning. The labor market is not collapsing, but the latest NFP came in to 57K, below expectation and below previous. Now, the most important part here is that this previous number is actually wrong. Why? Because the BLS has revised the previous two down by a net 74K. Essentially, they're saying, hey, the previous two statistics, the previous two numbers were wrong. It's actually lower by a net 74. April was revised down by 31,000 and May was revised down by 43,000. Okay, we're talking about the April NFP and the May NFP that have been revised lower. So the actual number was lower than what it was reported. So the labor market was softer than what was actually reported. Now, this is a small hint that it's hidden behind the scenes, but it's important because that tells us that this is not a hot labor market. It's more like a frozen one, okay? It's more like a decent labor market, but not doing extremely well, okay? And this allows the Fed to not be concerned about what they would be otherwise concerned, which is a wage spiral. Essentially, people demanding for higher wages, and that embeds entrenched inflation into the economy. They absolutely don't want this, but with a labor market that is not too cold, not too hot, the risk of a wage spiral is much lower. So the checklist reads like this. We've got inflation that is down to 2.6%, core inflation that is down to 2.6% from 2.9%, and then we have a labor market that is frozen. And I understand frozen, it's a bit of a harsh word. It's not exactly frozen, but I just want to let you understand the point here that the labor market is not extremely hot, okay? Now, what we're doing here and what I want you to learn, we're focusing on the two data points that make the mandate of the central bank. And this is what makes fundamental analysis simpler for you and more efficient. Because instead of looking at GDP, PMIs, retail sales, you can look at that. But when we actually need to fully understand what the Federal Reserve or any central bank is most likely going to do, we have to look at what their mandate actually forces them to do. And most of the time, with the Federal Reserve, the mandate is inflation and labor market. So by understanding what these two data points are doing, we understand what the Federal Reserve is also most likely going to do next. And right now, we understand the context as inflation lower than expected and the labor market that is not too hot. Does this call for a rate hike as soon as this FOMC meeting on Wednesday? No, just simply no. At least not this week. Now, maybe in September, but that's another story because for now, what matters is that this FOMC meeting is missed because right now, the market is pricing this 31% chance of a rate hike at this FOMC meeting. So what do you actually do with all of this information? Because theory is nice, but let's actually understand a little bit of practice here. So let's look at the dollar. The dollar right now is sitting around 101 thanks to the latest surge, obviously, in energy prices, which have raised the likelihood that the Federal Reserve may in fact need to hike, which is what brought the current FOMC pricing to 30%. Now, with that 3% chance of an interest rate hike, what happens if the Federal Reserve does not hike at this FOMC meeting? Well, the dollar in that case would be pretty disappointed and it would drop because it's the same way as saying the Fed, is expected to hike and they haven't hiked, okay? Now, obviously, a 30% chance of a hike is not an 80% chance of a hike, so the drop is not going to be massive, but still, 30% is going to be worth 40 to 50 pips lower on the dollar once it realizes that, hey, the Federal Reserve is actually not going to hike. In other words, to make it as simple as I possibly can, what I'm trying to tell you here is this. What I'm saying is a market that is overly positioned for a Federal Reserve hike that will most likely not happen. At least not at this FOMC meeting. So the market is overpriced for the Fed to hike, to be aggressive, but yet the context does not argue for the Federal Reserve to actually hike as soon as this FOMC. Sure, maybe they will hike in September. If inflation rebounds a little bit at the next sprint because of the higher oil prices that we've seen over the past couple of weeks, that will propel the debate for a September hike. Absolutely. But right now, at this FOMC meeting, well, I don't see the case for an interest rate hike. Not with CPI having dropped from 2.9% to 2.6%, and not with the labor market not extremely hot, okay? Which creates a scenario for the dollar. Now, we have two potential scenarios here. The dollar could chop or go a little higher into the FOMC and then be disappointed by the fact that the FOMC has not hiked interest rates. Or alternatively, what could happen here is that the market is smart enough heading into the FOMC meeting to unwind the expectations of this interest rate hike. So from 31%, it could go down to 10%. And the dollar in that would also price out the interest rate hike expectations. And this is what we call a front running of the event. So instead of suddenly dropping at the event, once the Fed does not hike, the dollar could slowly grind lower into the FOMC, expecting now the FOMC to not hike interest rates. Understand the logic here? So the point here is that with our understanding of the fundamental context, with inflation and the labor market, we understand that the context does not scream for the Federal Reserve to hike interest rates as soon as this meeting. Maybe it will in September, maybe it will, but not at this meeting. And so with this context, we understand this week, the most likely path ahead for the dollar should be most likely weaker. Because once the Federal Reserve does not hike interest rates, and by the way, with Kevin Warsh making things interesting with no forward guidance, well, he could potentially not hike interest rates and then at the press conference not even hint about a potential September hike. And what happens? Well, the market is going to see that as potentially dovish. Now, there will most likely be some dissenters at the FOMC on this Wednesday. FOMC officials that will vote for an interest rate hike. Could be maybe 2, maybe even 3 that could potentially vote for a hike. If there's no one voting for a hike, that's even a more dovish surprise. Okay, so no hike, no votes for a hike, and then a Kevin Warsh that goes out on the press conference and says nothing. Well, in that scenario, the dollar is going to be much lower. But again, we're assessing the probabilities here, okay? We're assessing the probability scenarios here where this week, I don't see the case for a rate hike at all, okay? And so the most likely scenario is either a grind lower into the FOMC for the dollar or a drop at the FOMC once the Federal Reserve officially announced that rates are going to stay on hold for this FOMC.